What is going on, ladies and gentlemen? My name is Maxwell Kosmalski. Joined with me is my co-host Nolan Klapek, audio master Jay Cotter, and the ninth guest of the New School Project podcast, Ron Williams III. Welcome, brother.
Everybody. Hello. Thanks for having me, Max.
Hey, thanks for coming. Yeah, we're really glad to have you. And anyone who's tuning in for the first time, thank you so much for listening. Your support means the world to us. A little bit about the New School Project. We are a group of guys who are just trying to do our best for the world. Our goals are to educate, empower, inform, and unite the people of the up-and-coming generation. We talk about things they don't want us to talk about. We talk about things that we feel like we should have learned. We shoot the shit. We teach you how to not get screwed over by our corrupt government. And we talk about aliens.
100%.
So basically everything.
Ooh.
Yeah,
How does that relate to mortgages? I'm sure we can find a
aliens
connection,
relates to everything. You'll see at the end.
Too on Twitter yesterday that they said they have found some alien signal or some sort of signal from the new images out of the James Webb telescope.
Oh yeah.
Shit, is that right?
They've heard. I read something. I don't know how true it is because you never, you got to take everything with a little bit of grain of salt that you see on Twitter. But they apparently have found some sort of signal that is emanating.
Some
there.
movement. Huh?
Something.
Honestly, I feel like it's almost a matter of time something like that happens. I mean, I imagine there's probably millions of intelligent civilizations across the entire universe. Like, it's so vast we can't even begin to comprehend it. I mean, you'd think there'd be signals going fucking everywhere.
Exactly. I mean, there's two realities out there. Either we're alone in this universe or we're not.
Which one is scarier?
They're equally as scary, in my opinion. They're equally as scary.
That's how I feel about life and death. I'm like, life is fucking scary, man. Death, also scary.
Mm-hmm.
Yeah.
But we usually blindside our guest and be like, Max does, and he's like, do you believe in aliens? But I guess
I guess
we're coming out with it,
There we go.
Yeah, fuck
yes, for the
All
record,
right, so
I do believe in aliens.
All right, so he believes in aliens. All four of us here, we believe in aliens. Maybe that diminishes our credibility. Maybe it doesn't. That's not the topic of conversation, though. Our friend Ron here, he's a mortgage lender. He and I have done some business together, as I'm in real estate, and he writes mortgages and whatnot. And we're going to talk about what's going on in the markets, because a lot of crazy shit has happened. Rates are going up. Affordability of homes is decreasing. Home prices are they've just been going through the roof. And, some people are like, oh, that's great. My house, my equity is increasing value. But what about the guy who hasn't bought a home yet? It's going to cost him a lot more. So we're going to dissect all this stuff. We're going to have some fun with it. We're going to, we're just going to spitball with
So
this.
tell us a little bit about yourself, just to start off. We don't even got to go into the mortgage lending right away,
Okay. Well, I'm Ron, for the guests here who didn't hear when Max was doing his lovely intro. I am a graduate of Albion College. I graduated there in 2017 with a degree in finance.
Nice.
Got my career started in mortgages shortly after in 2019 and been doing it ever since. Other than that, I did play baseball in college, so I was a collegiate athlete.
There we go.
And that was a huge part of who I was for most of my life until post-college. Other than that, I'm an avid exercise enthusiast, and I love gaming in my free time.
Awesome.
Pretty much all my time is spent either writing loans with my family or sitting at my computer playing some games.
That's awesome, bro.
So what made you get into mortgages?
It honestly...
Did you know you were going to get into it in college?
No, I did not have a plan in college to get into mortgages. My dream as a kid was I want to be like Jordan Belfort, and I want to make it on the New York Stock Exchange, be a stockbroker, and slang stocks out there.
Nice.
Got an internship when I was in college and kind of realized that world wasn't everything that you think it is as a young kid.
Oh, yeah.
And it wasn't really my opportunity or my bag of tricks, so to say. So I didn't really enjoy it very much. Got an opportunity, though, to study and do mortgages in 2019. That kind of came onto my plate. Not really asked for, but the opportunity was there. And I've been doing it ever since. I really enjoy it. Got to learn under one of the best managers who has over 30 years in experience in the game. He's been through the early 80s, been through the 2008 financial crisis. So a lot of the things that we are possibly facing in today's real estate world.
Mm-hmm. Awesome. Yeah, that's got to be great having that experience because, I was I don't know, 10 years old when, you know, the 2008 crisis was going on. And I mean, obviously I wasn't paying attention to stocks, mortgages, what the Federal Reserve was doing and this and that. So all I can do is look back in hindsight and, you know, try to interpret the past and see what might be
What the future could
yeah.
be like, right?
Yeah, absolutely.
For sure. And seeing the market that we're in, and I'm sure we'll touch on this in a little bit later, it's so vastly different from 2008, but it's much more akin to the market that we had back in the early 80s. The main reason for that is the big I word that's out there. I'm sure you guys know it. No, not interest rates, the other one.
Inflation.
Inflation.
That's why our market today is going to be a little bit more akin to, I believe at least, that time in the early 80s when we did see such high inflation rates.
Well, we were talking to a guy today, and he was saying that in 2008 there was a bunch of, at least in this area, there was like 1,000 homes foreclosing a month. Yeah. But the market that's like we're going through right now is different than 2008. That's what he thought. So it's cool hearing that, like, you just add on and be like, yeah. And then I think it could be more related to the 1980s because he said nothing about the 1980s.
I think it's going to follow that a little bit closer. From the 2008 times, people back then, when we were going through that foreclosure crisis, a lot of that was due to the fact that almost, I believe, 60%, I could be completely wrong on that statistic, so don't 100% quote me, but it was a very high percentage of mortgage loans were either non-QM loans, which are not your standard Fannie Mae, Freddie Mac conventional style
or adjustable
loan
rate
products. They were adjustable rates. They had something back in the day called NINAs, which were no income, no assets. If you had a pulse, you could get approved for a loan. They would give you an adjustable rate. Your initial rate would be ultra low, so it doesn't matter how much income that you make. You qualify for it.
And you'd probably get a fat commission selling that. So it probably further incentivized the brokers to...
Yes. The mortgage pay structure, from at least what I was told by my manager and mentor, was vastly, vastly different back then. He would tell me stories about, I could sell a $150,000 house and make near $10,000 on a loan doing that.
Jeez. Where does that money come from?
So,
shady people. If you want a great movie to watch The Big Short. That'll explain a lot of it.
Oh, I've seen that. I love how they cut to the celebrities. They're like, all right, obviously you don't understand this shit, so here's Margot Robbie to explain what a mortgage-backed security is. And then they had Selena Gomez just explain what a collateralized debt obligation was. I thought that was funny. But I think in that movie, the turning point when Steve Carell?
Yeah, Steve Carell was in the movie.
Yeah, so he realized, like, oh shit, this is bad. When the stripper he was talking to told him that she had 6 houses, and they just like gave her all those loans, and he was shook after that, and he fucking left. He made some phone calls. He's like, this is fucking bad.
I want to say, I don't know for sure. I think it might have been Leo. I think Leo may have been in that movie too. Or I could be thinking of a different one where he was sitting in a bar executing the final trade, so to say, that, kind of sealed the deal in the movie. It might have been him, might have been Steve Carell's character. I forget.
Not certain.
I could be thinking of a completely different movie too.
It is a good movie though, because most people don't really understand the great financial crisis and how that basically it destroyed people's wealth. It destroyed people's 401ks, retirement accounts.
Everything.
It collapsed the value of people's homes. It forced people out of their homes.
So how did it do that? And then like when you said it, like an adjustable rate is different than like a normal rate. What do you mean by that? And like what are the repercussions of an adjustable rate?
So when you get an adjustable rate mortgage, typically your mortgage period is locked for a certain number of years. Most commonly done in 3, 5, or 7-year increments. So for that first time frame, your monthly payment is no different than if you had a traditional fixed rate mortgage. But after that initial period is done, your interest rate can adjust by whatever that margin is for your loan, plus the rate of the current index. And while there are caps on how high that rate can go, if that fully indexed rate is much higher, you're going to get hit with a much, much higher payment. So that shock back in 2008 to many homeowners that could only qualify for a much lesser home if they were getting a traditional mortgage, when their payments adjusted, they could no longer afford it.
Holy shit.
Combine that with everything that was going on with the stock market, the auto industry, and all the massive layoffs that started there, sending the whole economy into a massive recession. Nobody could then sell their home for what they bought it for. And that's why you saw so many foreclosures. They owed more money than they could sell the house for, and the bank had to foreclose on it.
Yeah, and then they would package up all these mortgages, and then they'd offer them out as investment vehicles. You know, any Joe Blow could invest in these. You know, the Federal Reserve owns a lot of mortgage-backed securities.
Yes.
And it's just a cluster of mortgages, and basically they were rated higher than they actually were. So they were garbage. They weren't worth much, but everybody thought they were worth a lot.
Yep.
And then, you know, to further diversify, they would take all the mortgage-backed securities and then combine a whole bunch of groups of mortgage-backed securities, put them into CDOs, which is a collateralized debt obligation, and then it'd be an even bigger, further leveraged financial product. And eventually the chickens came home to roost, and you know, someone got caught holding the bag. I believe it was
Lehman.
Yeah, Lehman.
Lehman Brothers.
And who else went down? Who's that fucking guy from that show? The truck. He went there with a truck and $100. Oh, Bear Stearns.
Yeah.
Yes, Bear
What's that
Stearns.
show called?
Undercover Billionaire.
Yeah. Glenn Stearns starred in Undercover Billionaire, and it was kick ass.
that-
But
Okay.
but yeah, Bear Stearns went under, and you know, shit got real bad. Have you seen it's either Margin Call or oh no, it's Too Big to Fail. Have you seen that one?
I have not seen that.
It's just like The Big Short.
Okay.
And they
I'll
have
put
like
that on
the
the list.
they have like the Treasury Secretary in there. You know, obviously an actor, and he's playing Ben Bernanke, and he was the chairman of the Fed. I don't remember the name of the Treasury Secretary or whatever, but they explained how like they were trying so hard to not use taxpayer dollars to bail out all these big corporations until, you know, this big conglomerate, AIG, which is a huge insurance provider, they've got pensions, 401ks and all that. And then once they decided to use taxpayer dollars and, you know, start printing money and stuff to bail out these corporations, it was because AIG was going to go under, and that would have people would have
the whole financial ecosystem.
people would have woken up and been like, all right, after 55 years of hard work, my $790,000 that I have, you know, saved up in my retirement, it's gone. AIG went bankrupt. So that's how it got to the point where like cataclysm, or we print money and kick the can down the road.
And with both you guys, are you guys talking about 2008 specifically?
Yeah.
Yes, this is 2008 that we're talking about right now.
So like so with our market right now, right? Somebody like us is trying to buy a home, you know. What are the problems that we face that are like more related to the 1980s in your opinion?
Affordability.
Okay.
Affordability is the biggest issue that we have in the housing market today. The second issue is supply. And a lot of that is from the fear of 2008 occurring again. We have vastly, in the last 14, 15 years, however many years it's been, 14 now, underbuilt the number of homes that are needed to sustain our population and home growth. So combine that with a lot of other factors that have happened, and I can touch on that too. That underbuilding has created a supply issue, which that is the second piece of the biggest challenges that people are facing in the market today, which we didn't necessarily have that in the 1980s. It was mainly that affordability piece, where the market, we were in a recession, people weren't earning as much, and interest rates back in the 1980s, early 1980s, they shot up to as high as 18%. So I do have it written down here. Back in 1980, your median price home was about $47,200. So if you were putting 20% down at the time, which was pretty standard back then, you'd have a mortgage for about $38,000 and at a rate of 18%. I use an average of 14 here because over the course of the entire 1980s, it went from 18% to about 10 by 1990. So your payment would be about $450 a month. At today's rate and prices, that would be about a 6% interest rate, with your average home price being $450,000. Now that's nationally, and so may not be localized to where we are here in Oakland County, Michigan. That is the national average at $450K. At a rate of 6% and doing that same 20% down, your payment is looking to be about $2,158 a month. That's not including your property taxes, your homeowner's insurance on the home, upkeep of the home, utilities, every other thing that goes into home ownership. That's just purely your principal and interest payments on the home. So right now,
So
with
20
prices being high,
what's that times? Holy shit! Yeah, that's a lot of money.
yeah, it's about
Yeah.
5 times as much as then.
For an average person, like to go about life, that's a shit ton of money.
That's a lot.
What
Yeah.
what about what about that 450 in 1980? You know, was that the number?
No, you said
A
something like
month?
50,000. Was
Or-
it?
It was about a $50,000 home, we'll call it, and your monthly payment, just including your principal and interest, probably would have been about $450 to $500.
And that
And that's doing 20% down. So your down payment is much less in terms of 1980 dollars as opposed to today's dollars.
wow.
People today shit their pants hearing about mortgage rates on the 30-year being 6%.
Yes.
So
We've been spoiled
Yeah.
the last 2 years with mortgage rates.
yeah, but there is like a dichotomy because the 20%, it would be horrible on a home priced at today's valuation, but it's not nearly as burdensome on a home back in 1970, 1980, where the home is like damn near 1/10 of the value, maybe 1/5.
Yeah.
So
Home prices have increased by about tenfold since 1980, roughly, if you're looking at just a straight numbers average.
So, I'm glad we brought this up, and
Thanks
I wanted,
thanks for sharing that, man.
Of course.
yeah, people need the perspective because, I mean, I don't know, we have been spoiled, like you said. I mean, I think the real winners of the 2020s are those who refinanced their house or bought a house and got a 30-year at 2.75% or something like that.
Yep.
In a currency that has lost 9.1% just in the last year. But I did want to ask you, and I'm sure you get this question in your business a lot, is the housing market going to crash? Do you think this could be anything like 2008? And I know you said it's more resemblant to 1980, but do you think we could ever have any kind of crash, or do you think inflation and material prices increasing will just keep housing trickling up? Do you think there'll be supply-demand equilibrium met where more people are producing, so there's more supply, therefore the demand gets leveled out? What do you kind of see for, I don't know, maybe the next 5, 10, 20 years?
So
in the
I'll
housing
start off
market?
with answering your first question here is, will there be a crash? No, there will not be a crash. That is my personal opinion, and
I'm in that
the
camp as
opinion
well.
of many experts that are in the real estate field today. However, there will be a correction that we will see, and it's going to be dependent on area primarily, because as I mentioned before, affordability right now has been crushed. Looking back, not comparing things back to 1980, looking back and comparing to just January 1st of this year. So going now 7 full months backwards, you could have got a home at a 3% interest rate, and using that same national average, that average would have been about a $370,000 home that you would have purchased. Your monthly payment would have been about $1,250. So if you go back and think $2,150, $1,250, that's about a 60% increase to payment.
Wait,
overall.
a $375,000 home for $1,250 a month.
That's your principal and interest. So you don't have taxes, insurance,
Right.
and any of the other things. So your upkeep, your utilities, that would just be your principal and interest if you bought a $370,000 home and you did 20% down at a 3% interest rate, which
Okay.
very, very many people did at
So
the
what-
beginning of this year.
What would that cost at today's interest rates, near 6%. Might
So
be a little shy of 6 now.
for that same $370,000 home, if you give me a minute, I can do the math on my calculator here.
Yeah, let's
find
run
out.
some numbers because I am
100%.
incredibly curious.
Let's find
This is
out.
awesome, man.
But in certain areas, going back up here, in certain areas, you will see what some may define as a crash in prices.
Yeah, like people flooding out of New York City or something.
Exactly. Your areas, so we'll take just California, for example. I've seen numerous posts on Reddit, subreddits of real estate, people that are dooming and glooming and thinking, oh yeah, everything's gonna crash. They're praying for a market crash. Where, yeah, people that bought a house in 2021, you buy $1 million home and you're trying to sell it now for $1.5 million. Yeah, that's not gonna happen. It's unrealistic to think that home prices can appreciate at a 10 to 20% a year clip year after year and keep going. It's just not possible.
It just shows something's out of whack if you see crazy stuff like that.
Exactly. Not everything that goes hyperbolic eventually has to level out some. So we're going to see a correction. But
That's that gravity shit, dog.
Exactly, man. With that correction, though, what people need to understand is home price deceleration is not depreciation. Home prices year over year are still going to go up in a majority of areas across the United States. It will be cheaper to buy a house today than it will probably be to buy a house a year from now, 2 years from now, 3 years, 5 years. One of those reasons is show me a builder that can build a $110,000 house and make it worth their time.
That's very true. And
Nobody's building those. They can't build super cheap housing. The only cheap housing they can build is multifamily, which I don't know the exact statistics, that's one of the few areas that builders are actually building more homes of. Multi-unit starts have been increasing pretty much month over month still over the last 6 to 8 months here.
What do you mean by multi-unit? Like multiple families?
Multifamily homes, so 2+ units in a home. Could be anywhere. That multifamily unit starts metric that we watch is anywhere from a 2-unit home to if somebody's building a 60-unit apartment building. That still counts as one multi-unit, multifamily start. Of course, that's why.
That is
Don't
so
you love
wild.
when your phone connects to a Wi-Fi network, but it doesn't actually give you the Wi-Fi?
Which Wi-Fi are you on?
I don't know, probably some Xfinity or AT&T Wi-Fi because you connect to it once and then it's like when you go to McDonald's.
I can give you the Wi-Fi.
How you connect to every
I
single...
can't say it. Yeah, I can't say it.
We're giving out passwords here today. Everybody, if you want free internet, contact these guys.
Jay's like, dude, we cannot afford to get hacked, bro.
That's the one that it tried to connect me to automatically.
You're a balmy
Yeah, if
blazer.
you just want to pop that in, that way I can pull up what that 300K home would be at for a 6% interest rate, but it'd be much, much higher.
so, do you think the rates will continue to go up?
Yes. At
How
least for
high
a
can they
little
go,
bit, a
though?
little bit of time. So right now, the mortgage-backed security market, which it doesn't exactly dictate what is 100% going to happen with mortgage rates. However, mortgage rates do very closely follow the mortgage-backed security market. That market has priced in that we're seeing a 75 basis point hike tomorrow. at
Which
the
is
FOMC meeting.
0.75%.
Yep.
Everybody.
0.75%. So that'll put it, I think they're almost approaching 3 now. I think they were just under 2 at the last meeting, or right around 2%.
What, the Fed funds
Yeah, for
rate?
the Fed funds rate. So that's where that is. After that meeting, the market is pricing in maybe a couple more rate hikes before the end of this year, because everybody knows it. We're already in it. And the numbers are going to show it this week, I believe, with GDP growth, negative GDP growth, rather. We're going to go into a recession.
Ooh, don't
when
say
we
the
go-
R word on the
when we go into-
podcast.
I think we're already in
I'm
a
just
recession.
playing.
Anybody?
Oh, we are.
You feel it. Everybody can feel it. You go to just even the gas station, your gas is more expensive. Your eggs are more expensive. Your bread, your milk, everything that you're buying right now is more expensive. We talked about how builders can't build cheap homes anymore. Lumber prices.
Lumber prices
Producers-
came down though.
They've came down, but they're still
100%.
elevated.
Yeah.
They've came down from their peaks.
Oh, yeah.
They're still higher than pre-pandemic.
Oh, hell yeah.
Everything is costing
Everything
more.
costs more. We're
Yeah, and
already in a recession because we're not selling more goods and services at all. People
Mm-hmm.
aren't. Everybody's cutting back. I know several clients that I've talked to. Normally they take vacations every single year with their family. This year, they're not. They're maybe staying somewhere local. They're going somewhere here in Michigan where they can drive versus taking that trip to Florida, going down and spending a week in Texas. So
Yeah, I really think we are gonna get the numbers on
I
Thursday.
don't know why that's not
Negative GDP growth, and
Have we had positive GDP growth until this point?
no, Q1 was negative 1.6.
Yeah.
I think they originally called it at negative 1.1 or something, and then they revised it to negative 1.6.
And that's typical. Every single major metric and reading that comes out that the federal government and all these economic data points that they use, they are revised every single month. As things get more accurate, reports are reviewed, audited. So that's very typical for them to revise numbers either up or down.
Well, I
each
mean,
and
you
every single
gotta
month.
know. I mean, you're giving the people their mortgage. You know what I mean?
Yeah.
100%. So you get to know, huh?
I get a little bit of the know-how. My specialty, I listen to our bond traders, who they are the ones that actually deep delve into all the economic points and what they mean. I more so interpret them into how is it going to affect the everyday person.
Yeah, that's what I want to get into because, like, knowing this, you know, like, what would you do? You know?
I would save up. I would save money right now in terms of if you're somebody that is looking to buy a home, the best time to buy a home is when you can. The benefits of home ownership will always outweigh those of renting unless you are only staying in an area for a short period of time. So one thing that I always tell my clients that I work with is if you can answer yes to 3 specific questions, you are ready to buy a house. Do you like the area that you're going to live in? And do you see yourself living there for a while? Usually greater than 5 years. Can you afford the monthly payment? That's the biggest one is can you afford the monthly payment that it's going to be? Truthfully, because
I thought there was going to be this big buildup on the number 3, and you were like, can you afford the monthly payment?
that's the biggest piece is, as I've said, affordability. And can you truly afford that monthly payment?
Yeah, there's no
I've had
reason
many
to buy it
clients
if you can't
where
afford it.
they've given me ranges of, okay, I want to get a home and I can afford to pay $1,500 a month. Well, here's what you can afford at $1,500 a month. Here's your options. If you're looking at a single family home, you can get A. If you're looking at a condo, you can do B. It's all about that affordability piece though. That is our biggest thing that I always make sure that every client I work with.
They're not like stretching themselves out.
Nope, you don't want to stretch yourself thin because while there's a number that you can qualify for on paper, that may not necessarily be the number that you're comfortable paying every single month. Because that number includes, so a typical mortgage, unless you're doing 20% down, will include your principal and interest payment on the loan, your private mortgage insurance payment, your homeowner's insurance, as well as property taxes, or if there's any HOA fees that are assessed for the property. So let's say you buy in a really nice community or you buy on a lakefront. Typically there's an HOA that you got to pay for every single month. All of that is all encompassed in your mortgage payment. What that doesn't include is your bills that you got to pay, your utilities, any other debts that may not appear on a credit report. So if you have kids, your child care, you know, how much gas you pay.
The random shit that's going to break.
Yep. You know, if you got an OnlyFans subscription, that doesn't show up on your mortgage.
No, 100%, bro.
So let's get this number.
Yeah, my app
I
that I
feel bad
usually
he's
use
had
for
his phone out for like
for some
5
reason I
minutes.
usually have an app that all my clients use to get a completely digital mortgage. Typically, you're able to look up payment, affordability, get terms for different types of loans on there. So conventional, FHA, VA, USDA loans, and it allows my clients as well to then do their whole mortgage. So upload their documents, sign everything. For some reason, though, it is just not wanting to work. So I'm just going to Google a quick amortization schedule calendar here.
Well, if it's too difficult, it's not a problem. I was really just curious because I mean, rates doubling in 8 months, 7, 8 months, that's honestly historic. You know, when we saw Paul Volcker try to combat the inflation from the 70s, he brought interest rates up, like he was saying, up near 18%. And that was because, you know, we had raging inflation. And what's funny is they're combating this 9.1% inflation with a measly little 0.7% rate hike. Like it's because we would go bankrupt if they raised rates to that point. I mean, not only homeowners, you know, they wouldn't be able to afford homes. We wouldn't be able to afford the interest on our national debt.
If the government raises rates too much, not only the U.S. government, but pretty much every global government in the entire world would begin defaulting on their debt. Nobody could afford it until Congress passes another kick the can down the road bill and says, hey, now we can afford to pay more on our debt. We raised our own credit limit that we have.
Kick the can round 3. When do you think they do that?
Well, this is, you got to think
whenever
that
they
Next
need to.
4 years.
Whenever
or so?
they need to, they'll just keep kicking it down the road. Say, yeah, we can afford more and more and more and more debt.
I don't
as
think it's a
country.
road anymore, though. You know, like
It's a highway.
when they
downhill.
no. When they used to have to print money. You know, there used to not be an internet. You know, now there's an internet. It really makes me think about how, like, man, what's this money? Is it even money? You know, like what if
Now we got
J.P.
digital
Morgan's
money.
just like typing in how much money's in their bank,
Bro,
sending it.
They literally hit keystrokes, and then the Federal Reserve fucking prints out $2 trillion.
Says, hey, G,
That's economic output, dude. What? How?
Who's
Fuck you guys. I get charged with counterfeiting if I do that shit. You motherfuckers get voted in again. Fuck you people.
Max went off on a rant.
I like how you're dealing yourself here, G.
Yeah.
Here's a few trillion. Keep some for yourself.
He's a few
Seriously.
chili.
I am displeased with the fact that they do that. I'm struggling. Everyone I know is struggling with this inflation.
Hats off, man. What the fuck is going on?
You got to flip the hat backwards now. Shit's getting real.
All right. Have you?
$17.99, so
Okay.
$1,800 a month for that same $300,000 loan
Oh,
at today's
that's
interest
disgusting.
rate of 6%.
Wait, all right, say that one more time. What was the rate that you were trying to find? Bring me back to speed.
So beginning of the
$300,000 house or $370,000 house, about a $300,000 mortgage at a 3% interest rate puts you at $1,250 a month. That same exact loan, $300K at today's interest rate is $1,800 a month.
So the moral of the story is,
Get
if
a
you were
raise.
searching to buy a house, it would have been better to have bought it 7 months ago rather than today.
Yes.
And that's unfortunate. That's very unfortunate because, you know, I don't even own a home yet. I don't want to see all this shit going on. I prefer affordable homes rather than unaffordable homes. You know, obviously I'm not a homeowner. I could care less if the home prices are increasing other people's net worth, but that's honestly atrocious. And we're not here to like yeah, I'll shit on the people at the Federal Reserve, but what they have done with the rate hikes is responsible. I mean, they need to do that to combat inflation, but now, I mean, you know, if you want to get a $370,000 house, you know, back in January, you could afford $1,250 a month. Now you're $1,250 a month. I mean, that might only get you a $250,000 house.
Yeah.
So-
Your home prices, your affordability metric is going to go down for sure. It's probably down by about 40 to 50% compared to
Jeez.
where things were at the peak of, I would say, the best time to buy a home, which would have been mid
Late
2021. So summer of 2021 or early 2020 really would have been the best time to buy a home is early 2020 because then you could have got a 3.5% rate. You would be really happy. And then in 2021, after you've owned the property for a year, you can refinance it and get a 2.75 rate. So your monthly payment goes even lower and your house is worth more. So you're real happy.
It was the best time to buy gas, too.
Yeah,
We had a
stock
place-
up on that.
We had a place not too far from here, 99 cents a gallon.
You can't
2020.
you can't stock up on gas. It goes bad.
I did not know that.
Yeah.
I've heard that. My dad told me that.
Maybe I
Yeah.
shouldn't have put that gas in my lawnmower when the seasons changed this year. No wonder it was sputtering a little bit to start out.
Wait, you left gas in there, or you left gas from the last year into?
I had a little bit of gas in a container left over, just a splash, so I popped it in my lawnmower. I forget what it was. It was some kind of catalyst that revitalizes the gas that's in a lawnmower. It's made to do that. That's what it's supposed to do. Some of your dad's just like, yeah, son, you go to the hardware store, you buy this, and you put it in your lawnmower.
Yeah.
Everything will be all right.
So then you pulled the ripcord and then it worked?
It worked. It worked fine. It just let out a few real bad sputters. Was sputtering pretty good for that first mow. And then I went to the gas station and got some fresh gas. After that, I was all good. Everything was fine. That is one of the hidden OP benefits, though, of buying a house and owning a home. You never know how satisfying it is to cut your own lawn and crack open a beer. You feel so good afterwards. You just get to look at your work. You appreciate everything. Like,
you
man,
stripe it?
Of course. You got to have the lines.
Yeah.
You got a riding mower?
No, push mower all day.
Push mower?
I've got a
I'm not
push
a bitch.
mower.
What about
I'm an razor bitch.
about that zero turn?
I don't need to sit down. I sit down when I take a shit. I don't sit down to mow my lawn.
Yeah, pecker.
Well, everybody sits down to take a shit.
Hey, I have a nice cold, a nice ice cold beer after I mow my landlord's lawn.
Hey, there you go. And you pay his mortgage too.
Yeah, he probably has it paid off. But,
Yeah, so how does that work?
but-
So if you own a house and then do you not tell anybody you're renting the house? Or like
That's mortgage fraud there.
Okay.
It depends on how you get your loan though. So there are different kinds of loans that you can purchase and different classifications of homes.
Sure.
If you're buying a house for yourself, that's considered a primary residence. That's where you live for over 51% of the year. Many people,
51%?
that's the rule. That is the rule. So I know
They
people
call it a
that
homestead.
they live at 2 different residences, but you're only able to claim one as your primary residence. So that's the one that they spend a little bit more time at. So that way they're not breaking any legal laws or tax laws, anything like that.
Sure.
There's also second homes. So you want to buy a vacation home up in the Mitten or up in the Thumb. You want to buy a house in Florida, in the Hamptons, let's say. You can buy that as a second home where your interest rates are going to be a little bit higher. Your costs are going to be a little bit more compared to...
Taxes will be more.
Taxes will be a little bit more because you can't get that property tax exemption for it being a homesteaded primary residence. So it's going to be a little bit more expensive to buy that second home as compared to your primary. Then you have investment loans. Investment properties, they require the biggest down payment minimums of any type of loans. Mm-hmm. Interest rates are going to be a little bit more. Typically, your fees that you pay to obtain that loan are also a little bit more. But then that is how you rent out your home. If you are purchasing it, there is a way that you can purchase a home and rent it out after you are done living there. You just have to live there for 1 year. Because typically whenever you purchase a home, you sign a document at your closing that is a mortgage document that says, I claim that I will live in this property for 365 days. After that point, you can rent it out. Buy another house and go live in the next one.
Wait, so like, run that back, if you can, the last minute, because
Okay, yeah, we'll go back. I'll use myself.
He
as
was
an
looking, he
example
was
here.
trying to
Yeah.
understand.
So
Yeah.
this is a real life example because it's me. This is something that I plan to do with the home that I purchased. So me and my
I'm
fiance,
pulling it out of you.
we purchased a home last summer in July of 2021 in Ferndale, and after we have lived in this home and we are ready to buy our next home, our plan is to rent out the home at the same mortgage or using the same mortgage to pay that mortgage that we have today, not refinancing it all into an investment loan because legally we don't have to. We've met our requirement of living in that home for a certain period of time. Now, if we did want to, and this is dropping some major mortgage knowledge, so if you are watching, make sure you got your pens out and you are writing this down.
100%.
So if you have an FHA loan, which is a loan that's backed by the Federal Housing Administration, you can only have one FHA loan at a time unless you meet specific criteria laid out by the FHA to allow you to purchase a second home using an FHA and keep your initial FHA loan. Typically, you're only allowed to have that one out. So in my case, when I look to purchase my next home that I buy, I will obtain a conventional mortgage in order to do so. But at that home that I purchased, I'm able to keep all the benefits, the tax benefits of owning that home that I have, and I'm going to be able to eventually rent that home out for much more than what my mortgage payment will be on that home. So I'll be able to pay that mortgage with a tenant and eventually then have
own
a
the
little
home.
bit of money left over for myself, possibly, hopefully.
Yeah,
You know,
so
like,
he's-
that's
but-
in a perfect world, you know, thinking of myself as the only one that needs the benefit as well from that.
But long term, you own a home.
Exactly. I own it. I own that asset. My net worth has increased pretty good since owning that home. Since year over year, I actually have this statistic. They just announced the Case-Shiller home price index, which is
I looked at that number for May. What's,
Yep,
what's
for-
the new one though?
For May, they revised it down to, I believe it was 20.1. I thought I wrote it down here.
Isn't that like the 10 like major cities? Or
Yeah,
something?
that's the
like
only
Philly,
thing-
Detroit, LA, New York.
I don't think
or
Detroit's
something?
in it. I'm
No?
pretty sure Detroit isn't in that Case-Shiller. The problem with that index, so don't think that, oh, just because that says 20% year over year gains, my house is instantly worth 20% more. That is only like 6 of the biggest cities in the entire country.
Right.
Like New York, LA, I think there's 1 or 2 cities in Texas, a couple out in California. And that's where they get that number from. But a 20% year over year gain, if that applies, let's just assume it did. You know, I don't know anybody that already is owning a home that wouldn't be happy with that.
Yeah,
right now.
that's 20K per 100,000.
Exactly. Now it's make believe money because you can't necessarily go to the bank and take your money out. You can with a cash out refinance. But that's a whole nother topic that I'm not.
Yeah,
not
but
ready
a whole
to go
nother
into.
day.
We
gotta
can go
refi it.
into all that.
Then you got to refi at this new larger rate, so it might be disadvantageous.
For most people right now, it is. However, for others in which I'm currently helping a client right now with this, it's actually beneficial for him. I'm taking him from a 2.75% interest rate. That was his rate that he refinanced into in 2020, or 2021 actually. I'm taking him from a 2.75 to a 6.25 interest rate. However, his overall monthly debt obligation that he has to pay is dropping by about $500 per month, even though his mortgage rate is doubling. He's taking the money out of his home because his home is appreciated by so much and using that money to pay off credit cards, paying off a boat, which all are at a higher interest rate than what he's going to have on his home.
Oh, so
So
you're
that's how it could make sense.
so your financial background helps you greatly with the whole mortgage thing, or you have to
Yes.
have a financial background to get to where you're at with mortgage lending.
I would say, yeah.
Okay.
It helps to have somebody who's knowledgeable and who cares more about the client. It doesn't make sense for the client versus, yeah, I can write a loan and get a commission. Knock those people downtown that like to sometimes go to space. Not gonna point any exact names, but it does help having that financial background, knowing what to do for a client in order to give them a full financial analysis of affordability. Does it make sense? And
Do you like the area?
do you like that area? Do you still see yourself living in the house for a few years? Because if my client were to tell me, yeah, I'm gonna sell the house next year, well, it may not necessarily be worth it. Let's take a look at how much more it's gonna cost you to take out this additional money, sell, what your fees are gonna be.
Yeah.
And see what that break-even point's gonna be. How many years do you need to stay in this home in order for it to make sense?
Yeah. I mean, those are the questions you need to hear when you're about to make one of the biggest purchases of your life. You need to know that shit, man.
Mm-hmm.
For sure.
Yes, that kind of touched on that too. So taking a client as well, here's another good example. I know we talked about how adjustable rate mortgages, typically in the past, adjustable rate bad. This is a scenario that adjustable rate mortgages can actually make sense for a client. And this is somebody that I helped out in 2019 when I first started my career, who was in this situation, and it benefited them greatly. They were able to sell the home and move on from the home that they purchased right in the peak of the pandemic. So they made a pretty penny. when they were selling the home. But they originally, when they purchased it, got an adjustable rate mortgage because they were a doctor. And there are special products for those that are in that medical field and medical profession to obtain very specific loan products that are conventional loans, but have different requirements to them
Based
because you're a
on,
doctor.
and you might move to
Yep. So this
different, like-
particular client, they knew they were only going to be in Detroit for at most 5 years while they were going through their residency and their first year post residency. After that, they were for sure moving out of Michigan and they were going to sell the home. They didn't want to rent because they didn't necessarily see the benefit in renting and throwing all their money towards somebody else's mortgage,
Right.
somebody else's tax benefits for owning that home, and they have nothing to show for it after the end of their 4 years of residency and medical school, essentially. So they ended up purchasing and did pretty good for themselves. Every time you pay a mortgage, you're paying a mortgage, it's just not your own. And every time you're paying your mortgage, you're paying yourself back a little bit of money. You're putting it into a separate savings account somewhere else that you're not really going to touch until you're looking to sell your house or
It's
think
paid
that,
off.
hey, I want to take some money out of this to do something. As I said, most common is pay off other debts that are higher interest rates. People as well take money out to pay for their kids' schooling, to do renovation projects. One thing that people sometimes have done as well is take their home's value and tap into that home's value to make other investments. Now that necessarily, I know we've talked a little bit about, investments, the Big Short, 2008 crisis. That's what a lot of people were doing at that time as well. We're using their homes like piggy banks. So
Oh, shit.
taking the money out, and putting the money in the stock market. Now they lost all their money in the stock market and they lost all their money in the home. The home's value's down. They're on an adjustable rate mortgage. Payment just shot up and the whole world all fell in all at one time.
Don't over leverage yourself,
Yes.
and that won't happen.
Yeah, don't over leverage yourself. There we go. That's some great advice.
So you go over like the whole thing, with your clients, I feel like.
Yeah. So I wrote this down of one thing that I wanted to talk about because me and Max kind of talked briefly about some of the points that he wanted to bring up. And I wrote down one that I wanted to talk about today, which is the overall home buying process and what that's like. And I feel like you just gave a great segue into that of how do I walk my clients through purchasing a home?
Yeah, brother.
Step one is to game plan and assemble your team. So majority of the time that I work with people, I get referrals from my realtor network that I've established. So people like Max who have individuals that come to him and say, Max, you're the guy that I talk to that wants to buy a house, or I buy a house from you. How do I buy a house? Max then sends those people to me to talk to me and have that game plan conversation. So we're going to have an initial consult. Find out where you want to live. What do you do for a living? How much do you have saved up? Let's find out the first step of where are you right now today? Here's the finish line of where you got to get to. This is home ownership all the way over here. But where are you on that racetrack? How far along are you? Or how much do you have saved up? Where's your down payment? Can you afford that monthly payment?
Right.
So we game plan and figure out all of those different factors of what goes into getting the mortgage. How are you getting that down payment? Are you pulling money out of your 401k to have that money for down payment? Are you getting a gift from family, friends? Friends typically aren't allowed. You can make a case in certain scenarios, but typically your friends just can't say, "Here, bud, here's some money, go buy a house." Normally, that's not allowed in the mortgage world. But if you're getting a gift from like a family member, an aunt, an uncle, your grandparents, somebody who wants to leave you some money, where's your down payment funds coming from? After that, we're going to go through what's called the pre-approval process. There's two ways to go about it. Some people go through pre-qualification. Some go through pre-approval. Pre-approval is always the stronger of the two, and it's more the norm. So if you go to try and buy a house and book a showing, a lot of sellers and homeowners don't necessarily want you going through their home to look at their house and see their inside personal life unless you're a fully pre-approved buyer.
Right.
Which that means that you can actually afford the home that you're going to see. A lender like myself has reviewed all of your financial documents, your employment, down payment. I've actually seen those documents in person. In front of me, you provided all of that to me. So that's pre-approval. Pre-qualification, on the other hand, is, hey, we're just having a conversation. How much money do you make per year? All right, about how much you got saved up? Well, based on, if you make $60,000 a year and you got $15,000 in the bank right now, I think you can afford about this. That's pre-qualification, which gives you a good ballpark, gives you a great idea.
Right.
Pre-approval is what you want to do. That's going to show that you're serious about buying a home, you're ready, and that tells you that you're right near the end of that finish line. Now, some clients aren't always right there right away. There may be certain factors that they don't have. So credit, income, assets, those are the big three.
Are those like, obviously those are their roadblocks or whatever, but it's usually never like their attitude is like, I don't want a home. Usually their attitude is like, I want a home.
Most of the time, if you're talking to me, you want a home.
Right. You don't really
They
have
don't
to
go to Ron because they don't want to get a house.
Like, you're not selling
Ron,
them. Yeah.
Here's my W-2s. Here's my pay stubs, my bank statements. I don't even want to buy this house, man. I just I don't know. I'm told I'm supposed to buy it. Here you go. I don't want this. Most of the time, people are really excited.
Right.
At least on the inside, you see the excitement for myself a lot at the closing table, because that's when everybody's like, we made it, we're done, we're signing the papers, it's real. Because buying a house is stressful. There is so many emotions that go into the home purchase, everything that goes on. You get a call from me, your lender, at 8 o'clock at night saying, hey, I need an extra document for you. Underwriting asks for a little bit more on your pay stub. They want to see a second one just to make sure. You as the buyer, you're freaking out like, oh my God, they asked for a pay stub. What does that mean? Do they need this? Here's a screenshot. Does this work?
It's stressful for all parties.
Yes.
I feel like, except the title agents always seem to just have their shit together. They seem the least stressed of them all. Would you agree?
You've worked with some very good title agents.
Legacy title? I mean, they know their shit.
They're okay. Legacy's all right. They're all right.
They're just all right?
They're not really around anymore as much in the market today. At least I don't see them as active. But they were okay. Yeah, the good title people are there. They're out there. I know a lot of the people who were at Legacy back when we last worked together. They were pretty solid.
They always came in clutch for me. I was always the one that was stressed out.
I like to say, your title people in the mortgage industry, they're your yes men. Hey, I need this done. Well, as long as it's not breaking any laws and it's truly legal, they're not, writing a title policy on a home that's really owned by somebody else, then you got somebody who's real shady and you shouldn't be working with them. Title people are your yes men. Say, hey, I need this document. Okay, let's get it done. Let's find a way. Whereas mortgage underwriters, they're the big bad wolf of buying a home.
Yeah.
What is that? Is that what you do? Mortgage?
No, I'm a loan officer.
Okay.
So
okay.
I'm the person who I help guide everybody through getting a mortgage and what that entails. So I collect all the documents, make sure that everything is good, and after I've gone through all the docs, I then submit them to underwriting for approval. So back to my list here.
Yeah.
Part of after pre-approval stage, you begin the house hunting stage, which that's co-op of stage 3, 4, and starting into stage 5 of the home buying process. So 3 is your house hunt. So just looking with your realtor and finding homes that are available on the market or not available through your realtor's sphere of influence. Many of the realtors that I work with, they find homes for clients. Say, okay, I know you need a 3-bedroom, 2-bath, you're looking for a specific school district, and you need a fully finished basement.
Right.
Plus an in-law suite, let's say. Where can I find that? Well, if nothing's on the market, they're going to go to their network and find something. So that's how house hunting is step number 3. So finding the home that you want to purchase. Moving into step 4, that's when you work with your realtor, your loan officer, and yourself to make your offer and formulate your offer. So how much are you going to buy the house for? If a home is listed at $250,000, what was typical, let's say, in the last year, I would say, we've been in a very, very extreme seller's market. So sellers, the ball is in their court. Whatever they want,
they're getting.
It's pretty much they've gotten. So a lot of homeowners have waived inspections, waived certain contingencies in their contract that would allow them to back out of the contract. A lot of those have been waived over the last year. So many of those homeowners, that's how their offer has been structured. They've offered over asking. Seller concessions have kind of went by the way by, and that's where a seller pays for part of a buyer's mortgage costs in order to help them purchase the home. That's really gone by the wayside, except for in specific situations. So your realtor, your loan officer, and yourself, you're going to formulate your offer. Then your realtor is going to put on the gloves and start negotiating with those sellers of how can we get this offer accepted so that way you can buy your dream home. After that offer is accepted, you're going to move into stage 5, which is your mortgage approval and your inspections. So you're going to have, if you don't have those inspection contingencies waived, you and your real estate agent are going to do inspections on the home, make sure it's a good, secure house. That way you know what you're getting into as a homeowner. You're going to see what kind of work does this home need from a structural standpoint, mechanical standpoint. You know, you get an inspection of the roof. If you have a septic field and your home's on a septic, you're going to get that looked at.
Just all the homeowner stuff that common
Exactly.
folk don't know.
Yep, you're going to pay a professional. They're going to go in and take care of it for you. Give you a nice report. Usually it's about 15 to 30 pages. That's going to tell you every single line item of, hey, I worked this room, here's what I saw in this room that needs to be fixed or could present issues for you as a homeowner. After that inspection is done, that's when you begin the full mortgage approval process. So you're going to actually have everything submitted to underwriting. If it already hasn't been in the pre-approval standpoint, that they'll take a look at it. The lender is then going to order an appraisal of the property, which that appraisal is for the lender and yourself to make sure that the home has the value that you are actually purchasing that home for. After that point, you'll get approved for your loan, and after you're approved for your loan, as long as all the conditions of the underwriter have been met, you will be able to close and be a happy homeowner thereafter.
Holy shit, dude.
Then you kind of like pass the baton to the title people to, you know, finalize all the documents
And then the title people.
Yes.
Yeah.
I love the title people.
You don't really hear about them until, you know, you get an accepted offer.
It's like you guys are talking about the title people like they're these like people in this village like off the way, and you're like,
They're the
you,
little Oompa Loompas.
you must go talk to the title people.
They're just the smart people that you end up on the phone with that come in clutch all the time.
Yep.
Or I guess sometimes they don't. I mean, I guess
Oh.
anybody can be a title agent.
I mean, holy
I had
crap.
a nightmare title situation because I'm also licensed in Texas as well as Michigan. So I write loans for homeowners that are living here in Michigan and down in Texas.
Nice.
One of my clients was purchasing in Texas, and as a part of Texas law for lending requirements, it is typical for the seller of the home to give a copy of the most recent survey to the title company and to the buyer, as it is a buyer's requirement to have a survey done on the home or have a survey that shows, yep, these are your property lines, they're correct, here's your boundaries for your home that you're purchasing.
Right.
That never happened for my last Texas loan. The sellers did not have a copy of the survey because it was done last in 1984, and title company never told anybody until a week before closing that, hey, yeah, we don't have a survey. What do you mean we're supposed to order a survey?
Jeez, did it all get ruined?
Oh, no, we found a way. We found a way. We was able to pull a miracle. Me and the realtor that I worked with, we were able to find through her connections a survey company that would be able to get out there in about 24 hours.
Oh, nice.
We took care of some of the costs for the client just to help them out, and had our survey back in about 3 days. It was on a Friday afternoon. So we had it next week on Wednesday morning, and we're able to close the week after that.
Boom.
Nice.
It was nice. It was a very, very stressful situation. The sellers of that home, they were buying a new one, and their builder wanted to back out of their contract. My buyer, their lease contract was up at the end of the month, and their landlord was going to jack their rent up by 60% or kick them out if they had to stay. So it was a tough situation, but we were able to get it done.
And these people are just like, you know, telling you all their problems, like the problems they don't tell anybody, you know.
Oh yeah, The amount of calls, so in the life of a loan officer, it is not a 9 to 5 job by any means. I will start my days at about in between 6 to 7 in the morning. Is when I'll make my phone available for any kind of phone calls, check my email, make sure that there's no fires that I got to put out in the morning. And I've worked as late as 2 a.m. before. Most nights I get phone calls from clients because, I mean, think about it. If you're working a normal everyday job, you work your 9 to 5, you don't have time during the day to handle your mortgage stuff, to get your mortgage documents together, to call your loan officer with your questions. You're going to call them on your way home from work or after dinner at 8 o'clock at night.
That's more often than not when it's later.
I would say more often than not later in the afternoon or people's lunch breaks is when typically I'll have client conversations. But I've had my referral partners, realtors that I work with, say, hey, call me at 9:30 at night, Ron, I need a pre-approval. Client wants to write an offer. I need to get a pre-approval letter for them. Need it now. Need it today. All right, let's get it done. It's 9:30 at night. I'm sitting on the couch, but let's go into the office and let's fire it up. Give me the client's name, number. I'll take their application. Let's get their docs, and I'll get you that pre-approval.
Fuck yeah.
Yeah, awesome.
I know Max and I've had conversations many times late at night over real estate and over some clients.
Yeah, I mean, same with buyers and or on the realtor side. They might decide, oh, I guess I know it's 10 o'clock, but I guess we'll actually write an offer. And I know they wanted it by tonight, so I guess that means you got to do it right now.
Yep.
Right now at 10 p.m.
Write that offer.
Shit like that.
Call me to make sure I can call the listing agent, talk to them, because building that rapport is one of the biggest things that helps my clients to win and have their offers accepted. Majority of loan officers, if you give them a call, they're not going to pick up the phone.
Oh, really?
Especially if it's an obscure time at all. And hearing from a loan officer during the transaction, if you're a seller or the seller's agent, so the listing agent of the property, usually you don't hear from them, especially if you're working with like a really big bank, an online lender. You're going to talk to John one day, Jim the next, Sarah the day after that. You might get Tim on the 4th day.
Rocket Mortgage. Is that how they're operating?
Rocket Mortgage, they have their systems down a little bit more than that, where if you call into them, it's kind of like your automated phone line,
Are
Press
they the
one
same
for
as
this
Quicken?
department. Rocket is Quicken, yeah.
All right, that's what I thought.
Rocket is Quicken. The two bigger players in the game today, in today's world, are Rocket Mortgage and United Wholesale Mortgage. Those are the two big dogs that are out there, really. Then you have your banks. Your banks are your other, the third head of that Cerberus of big mortgage people are your banks. Because typically most people think that, if I want to get a mortgage, I go to my bank and I talk to the people at my bank.
Right.
But you'll find a lot of times the service that you get as a client isn't necessarily the best.
Oh, hell no, bro. Come on now.
Everybody hates the big banks. Don't go to a big bank.
I'd rather call you than call somebody in a cubicle.
Exactly. When you call me,
Just
you're
being
gonna
honest.
get a real person on the other line, somebody who is local to the area. So most of my mortgages that I write are primarily in the Tri-County area. So Oakland, Macomb, and Wayne County. Those are my 3 biggest areas that I focus on. That's where I've lived my whole life. I grew up in Grosse Pointe, St. Clair Shores. That's where my dad lives. My mom and I grew up in Grosse Pointe. I live now in Ferndale, right over in Oakland County.
Yeah, so that's like a
You're
triangle.
getting somebody who's right
Yeah.
there. They know the local area. I know all the local markets, the local statistics that you're going to want to look at. People know who I am in the industry, so when I'm calling an agent, they're saying, yeah, I know Ron. I've worked with Ron before. I know somebody who's worked with Ron before.
That's awesome, man.
It helps my clients win.
So what's your email, brotr?
My email.
How can people get a hold of you?
My email is Ron, RON, at firstnationalmb.com.
Firstnationalmb.com.
Yes, First National Mortgage Bankers. That is the company that I work for. We're a direct lender. We are a branch of Mortgage One. They're a local Michigan company.
Okay. That's awesome, man. Yeah.
So there was couple more things that I wanted to discuss. So
Let's do it.
with the
Hell yeah.
home buying process, you know, you mentioned the conventional FHA. I don't know if you mentioned VA. Will you break down what the down payments usually look like? Because there is
Yeah.
a myth that often needs to be dispelled where you
Yes.
need like,
You
oh,
don't
I need 50.
20% down.
Yeah.
People, you do not need 20% down to buy a home.
People think
At
they
all.
need a huge
Really?
lump of cash to get a home, but like I've gone through some sales where I've had the seller pay my buyer's down payment before, or you know, an equivalent amount that went towards closing costs and whatnot. So dispel this myth for us, Ron.
All right, so we're gonna start with conventional loans, as that is your most common mortgage type. Conventional loans typically have a 620 FICO minimum credit score requirement. Now, if you're putting 620 or have a 620 FICO score, you're probably not going to qualify at the lowest down payment. Your down payment's going to have to be a little bit higher to offset that. So you got one metric of you know, your mortgage approval that is on the lower side. You offset it with something that's a lot stronger. Balance out that scale of things. 620 FICO minimum. And on a conventional loan, if you are a first-time home buyer, or you can meet certain income limits, so you make 80%, or your household makes 80% of the area median income, which is defined by Freddie Mac and Fannie Mae, then you can qualify and put as little as 3% down in order to purchase a home. If you don't qualify as a first-time home buyer and meet those income requirements, then, or you make too much money, rather, so you can't stay below that 80% number, your minimum down payment requirement is 5% down on a conventional loan. And that can go all the way up to getting a loan for $647,000. Essentially $647,200 is the maximum conforming conventional loan limit.
And then you get to jumbo.
Yep, that's
then
when you go to
what's
jumbo.
What's the minimum or normal down payment on that?
Typically, jumbo loans have a 10 to 15% minimum. It depends on where you're doing your jumbo loan, what correspondent program, and what lender essentially is writing that jumbo loan.
Who the fuck is Freddie Mac and Manny Mae?
Freddie Mac,
Fannie
Fannie Mae,
Mae.
though, that's Uncle Sam, brother.
Oh, okay.
That's Uncle Sam. Good old U.S. government.
I was
Yeah,
like,
your
who the fuck is
trustworthy
this
government.
writing
They
this?
are the ones that, so a Fannie Mae, Freddie Mac loan, if you write the loan, so U.S. government says, if you write the loan to these standards and meet these credit standards, down payment standards, income, we will then back that loan. And that is then what is bundled into a mortgage-backed security, and then the government buys those mortgage-backed securities.
But it's
Actually, the Federal Reserve buys them
Yes,
with
the
the
Federal
money that they
Reserve.
print out of thin air.
Yes.
There was a point where they owned 1/3 of all mortgage-backed securities in the United States.
Yep.
So they owned the debt of 1/3 of our people's mortgages.
And they don't believe quantitative tightening. It's a myth. It's a lie.
Yeah,
The
I don't know
balance
if
sheet
they
has
can
only,
afford
the
to do
balance
that.
sheet has only increased. But that is
What's it at? 9 trillion? 8 trillion?
I have no idea, but I know it's gone up by about 8 billion overall since the start of their quantitative tightening on June 1st. Mainly that's because a lot of their MBSs haven't rolled off since people aren't refinancing their loans and paying them off early, because they have been buying less and less mortgage-backed securities. But their overall balance sheet hasn't gone down.
So there's less people buying, getting a mortgage right now?
Yes. Mortgage demand.
Let's talk about that. 'Cause
Mortgage demand is at a 22-year low right now. And there's really 3 reasons, as I believe, as to why that's the case. One of them we've already talked about. It's the big-headed snake in the room. Mortgage rates are doubled. You know, affordability got crushed. It's 60% more expensive to afford that monthly mortgage payment right now. Second piece of that, we've already also talked about. Builders haven't kept up for demand at all for what our home buying and home building needs are as a generation. Millennials are the biggest demographic in our country, and most millennials are at their prime home buying ages. We are reaching that point now that, yeah, people want to buy houses. Typically people when they're in their late 20s to early 30s, that's when they look at purchasing their first home. They think, yeah, you know, I met this girl or guy, you know, whichever way you go nowadays.
Right.
And I really want to settle down with them, start a family, and buy a house, have something that's more permanent. that demographic in the millennials, they are reaching that home buying age. Supply is not there for them. The third piece nobody really is talking about is the fact that everybody has 3% mortgages right now. Why would you sell your house unless you absolutely had to? Because you're changing jobs, you just had a kid, and now you got to get them into a good school district. Unless you have to, why would you sell your house and pay 50% more for something that's a marginal upgrade right now?
I didn't even really think about that.
That's going to be able to what is going to crush home buying demand.
You could probably package the inflation into the first part, with affordability.
Yep, everything costs more. Inflation with things costing more, people haven't been able to save up as much money. I don't know the exact statistics, but I know how the graph looked of the U.S. savings rate for how much money people are saving. During the start of the pandemic, it went like this. Went way
money.
high up. Free money. We're getting
Helicopter money.
Yo, we got that stimmy. We get them stimmy checks. That shot way up. Everybody's saving a bunch of money. And then now, nobody's saving anything. So people are having a harder time saving up the funds that are needed to purchase a home. Even if you're doing 3% down, doing on a conventional loan on a $100,000 house, that's $3,000. Well, if you can only save $50 a month, it's going to take you a while to get to that $3,000 number.
60 weeks.
Jeez. It's 60 months.
Yeah, that's
60 months. That's going to take you 5 years to save that up, if that's all you can afford, because inflation's higher. Whereas people before, you could save a little bit more. And now you're spending more money elsewhere, and you don't have as much money to save.
If you can only save $50 a month, you're stretching yourself.
You should really be looking. Yeah, you should really be looking at your overall.
Well, that's the common
financial
thing
picture.
now. I mean, I saw a statistic: 1/3 of people making $250,000 are living paycheck to paycheck.
Yeah.
So I think people just are not financially literate, which is why we're here at the New School Project talking about this shit. Because if you're not financially literate, you could make $10 million a year, and you'll still end up spending $10 million a year. The object is to live below your means so that you can use that money to invest in your future.
By far.
And Case Schiller, what's the number we got for that? I don't think you said that one.
I think it was 20%. It was right around 20.1%.
Oh,
that is actually
so that was the number.
Yeah.
For June?
For May.
Oh, all right.
For May. June's will be coming out pretty soon once they have all the data.
What is that?
The Case Schiller Home Price Index. It takes a
Home
metric
prices in
of
big cities.
home prices of the biggest 6 cities in the country, essentially, and says, well, this is how much values have gone up in that time frame.
And you know what's funny about that? So they give us that number of like 20%, but if you look at the Consumer Price Index, which is our standard measure of inflation that our government gives us, and 1/3 of that weighting of that index, actually I think it might even be 35%, so about 1/3 of that index is weighted with shelter.
Yep.
And you know what number they used for shelter? 4.3%.
Well, they're mainly taking into, they're not taking into account the mortgage payment side of things. They're taking into account more your utility payments, so your gas, electric for shelter costs when they're looking at that 4% number.
What the hell is the difference?
Well, the home prices,
the roof
rents
and
have
the
gone
water,
up.
Rent's up 20% across the whole country.
Yeah, so
and
I just
newsflash,
feel
if
cheated.
If your rent hasn't gone up yet, that's only because you're locked into your lease and your lease isn't due. Because when it does come due, your rent will get increased.
And like all this stuff that that Ron's saying and Max are saying, it's also a reason to like, get smart, and like fight back, man, with your own intelligence, with your own mind, with your own like money. And what I mean by fight back is like play your game. Live the life that you want to live, follow your dreams, do the thing that scares you the most, because it's probably what you want to do anyways.
Yep.
And, take this advice, because there's so much shit that our parents told us, and they're like, you got to think about this or think about that. And yes, like maybe, some of the things were like, yeah, you know, you guys might have got played a little bit on that. We're not going to do that, you know. But a lot of the things are just like, yo, make these investments early, work hard now, buy a home as soon as you can, right?
Yep.
And if you do need to buy a home, here's obviously the guy to talk to, you know.
More than happy to help.
100%.
Even if you're not ready, the biggest thing that I talk with all my clients about is, hey, we know where we got to get you. How can we get you there? What's your game plan of how you can go from point A to point B?
Yeah.
The path is not always linear. It's not easy. Buying a home is the biggest financial decision that you'll make in your life, and you're going to do it maybe 3 to 5 times in your lifetime. I do this every single day. So it's always better to talk to a professional.
Absolutely.
100%. Well,
So we already know that Ron believes in aliens, and that's usually what we do to conclude our episode. So I guess that's a good wrap.
oh yeah.
Anything else anybody wants to say?
Yeah, absolutely. Thank you so much, bro. Give me some. My hands are sweaty,
Hell yeah.
but
Thank you for having me.
Pecker hit
This has
Mike
been an
as
awesome.
usual.
This has been an awesome time.
yeah. Thank you so much for coming
I'd love
in.
to come back on the podcast and talk about whatever the hell you guys want to some other time.
Absolutely. Well,
Well-
we've got the segment Max's Morning Market Mania, so I think next time, we should hop on Max's Morning Market Mania together.
Hell yeah.
Or maybe come in and dust the rust off on the gaming, bro.
I want to catch these hands, man. You don't want to catch these hands,
All
bro.
right. Thank you.
The question is, can I use the mouse and keyboard, or are you putting me on the sticks?
No, we're putting you on the
Either
mouse
or.
and keyboard.
Okay, then we're good. We're good.
Okay,
I don't
okay.
play on the sticks no more. I can't. I can't touch the console gaming anymore. I suck so much.
We'll talk to our boy Wonka, the captain of the New School Gaming team. Well, thank you guys so much for tuning in. If you guys got some value out of this, share the show. It means a lot to us. We'll be here every Wednesday, every week. Thank you so much to Audio Master Jay Cotter for killing it on the setup, on the mics, on the curtains, on everything. Tuning us in real good. Thank you guys so much for tuning in. Peace.